So you've recently retired or you plan to in the near future, and you've done well for yourself by saving $1 million or more in your 401ks, IRAs, or other investment accounts. But you're still not confident that it's enough to live your dream retirement. If this sounds familiar, then you're certainly not alone. But I'm here to tell you today that there's a simple solution to this lack of confidence: a better retirement income plan. So, in the next few minutes, we're going to cover three topics that I'm certain will change how you view your retirement savings as a tool to live your best retirement life. But first, my name is Jake Skellhorn. I'm a certified financial planner and the co founder of Spark Wealth Advisors. Throughout my career at one of the nation's largest wealth management firms, I noticed that most new retirees have a spending problem. But it's not spending too much, it's spending too little. We all know that life is short, so I started my firm to adopt modern retirement planning strategies that encourages retirees to spend more of what they've worked so hard for while still having a plan to avoid running out of money. The big wealth management firms are frankly never going to use this strategy because you withdrawing more money means less money that they can bill you on and less profit for their shareholders. So, to help you understand this new approach, we're first going to cover the pitfalls of traditional retirement income rules that you may be familiar with and why relying on them could be costing you time and money. Then we'll talk about how Monte Carlo simulations are an okay starting point, but they leave out a major piece of the puzzle that I think does a disservice to any retiree that's relying on them long term. Finally, I'll show you the solution that I call retirement income guardrails that addresses all the flaws of these traditional methods without the need for complex or expensive investments like life insurance, annuities, or private equity. I'll even show you how it works with a real client example at the end. So, a quick refresher for those who are not familiar with the 4% rule. It's a retirement income rule developed by an advisor in the 90s who did a ton of research into historical market returns. Basically found that if you withdrew 4% of your beginning balance at retirement and increased that amount for inflation each year, over any 30-year retirement period that we would have seen in the past, going back to the 1800s, you never would have run out of money by following that rule. It does assume that you maintain a 50% stock and 50% bond portfolio throughout a 30-year retirement period. So, for example, if you have $1 million, you would withdraw $40,000 in year one and then increase that amount for inflation each year thereafter. So, very important to note that it's based off of your beginning balance and not your balance every year. And that is basically the first pitfall of the 4% rule. It's only based off of your balance in year one, no matter how your portfolio performs over the next 10, 20, or 30 years. So let's say that you retire in 2025 with $1 million. You start taking out your $40,000 per year, but you see a series of strong returns in the market over the first few years of your retirement. All of a sudden, your portfolio is worth $1.3 million. Now that 4% would have equated to $52,000, but following the 4% rule, all you're supposed to do is increase that $40,000 by inflation each year. So you're leaving a lot of money on the table. The second pitfall is that the 4% rule assumes that retirees spend the same amount of money over their entire retirement, again, adjusted for inflation. A JP Morgan Chase study of over 5 million retirees' spending habits found that in reality, retirees actually gradually decrease their spending over time as they age and become less mobile. And the third pitfall is that the 4% rule was made to withstand the worst case scenario that we've seen in the markets historically. But what if you don't see the worst case scenario throughout your retirement? What if you see average or even above average returns? The same study found that there were plenty of other periods throughout history where you could have withdrawn 5, 6, or even 10% of your portfolio over 30 years and still not run out of money. That's 10, 20, or even $60,000 more than the 4% rule would suggest that you can withdraw from your portfolio to spend more time with family, more travel, heck, even buy a boat if you wanted to. Now, a step in the right direction would be to use something called a Monte Carlo simulation, which is a common retirement planning tool amongst DIYers and financial advisors alike. A Monte Carlo simulation allows you to put in several key variables for your retirement plan, including your age, your life expectancy, your investment account balances, and your market and inflation return assumptions. And it simulates 1,000 different scenarios of the likelihood that that money is going to last the rest of your life. The result of those simulations is what's called a probability of success score, which represents how many of those scenarios resulted in you reaching the end of your life without running out of money, whether that's $1 left over or $1 million left over. But here's the thing with probability of success scores and Monte Carlo simulations as a whole. In that example, the 20% of scenarios where you run out of money assume that you didn't make any adjustments to your spending throughout retirement, which any prudent person would do if they see their portfolio start to dwindle too quickly. The way that I like to frame this is not an 80% probability of success and a 20% probability of failure, but a 20% probability that something at some point will need to be adjusted in your retirement plan, which is most commonly your withdrawal amount. But the huge missing piece that Monte Carlo simulations don't address is when you need to make adjustments and by how much. Let's say that you start your retirement with $1 million portfolio and an 80% probability of success based on your inputs. You start to withdraw your money, but you also see a couple down years in the market, and a few years later, you're at $800,000. Well, your probability of success score is probably also going to drop as a result because all of those simulations are now based off of $800,000 needing to last the rest of your life instead of a million. Let's say your probability of success score is now 65%. Do you cut back spending? Do you wait longer? How much do you cut back? Monte Carlo simulations don't have any guidance for when and how much to make adjustments by. And no predetermined plan can lead to panic, poor investment decisions like selling right before the market bounces back, and sleepless nights for retirees. And that is where retirement income guardrails comes in. The goal of guardrails is to show retirees how you can spend more money by starting off with a safe spending capacity that has a low likelihood of running out of money, which as we've seen can be more than 4% in most cases. And while we can't predict the future, we can plan for it by understanding when the risk of overspending or running out of money and underspending or dying with a pile of cash in the bank is increasing based on how your portfolio is performing throughout retirement and not just based off that beginning balance. In my experience, this gives retirees the confidence to spend the money they've worked so hard for by knowing exactly what to do no matter how their investments perform. Let me show you how it works using a guardrails plan for a couple that I work with. So here's a couple that I work with. Their names are David and Brad. They have a little over $1.6 million saved for retirement between their IRAs, Roth IRAs, and brokerage accounts. And they're both 65 years old. Up here, we have their current spending capacity, which is the most that they could spend based on their current portfolio balance, with, again, a low likelihood of them running out of money. For reference, the 4% rule would suggest that they would withdraw about $67,048 per year, which is about $15,000 less than the guardrail strategy would suggest. And this number actually comes from a Monte Carlo simulation as well that we run in the background. And this is the number that comes from an 80% probability of success or 20% probability of adjustment. I then set guardrails for David and Brad's portfolio to represent that the risk of underspending is increasing on the top guardrail or overspending is increasing on the bottom guardrail over time as their portfolio changes and not based on that initial balance. Another way to look at it is if their portfolio increases to a little over $2 million, their risk of underspending is increasing, meaning there's a high likelihood that they're going to reach the end of their life with a huge balance left over, and they can safely start to withdraw about $1,500 more per month than their initial planned rate. And if their portfolio declines significantly, they will need to cut spending by about $350 per month to help reduce the risk of depleting their accounts too quickly. Here's the other thing that we take into consideration when planning out their withdrawals over their lifetime. We use an age-based spending path, which assumes that retirees, like the JP Morgan Chase study found, will gradually start to spend less money over their lifetime. So instead of increasing the withdrawal amount by the same amount as inflation each year, we increase it by inflation minus 1%. So what that assumption does is it allows David and Brad to spend more of their hard-earned savings in these early and healthy years of retirement, knowing that they're probably not going to spend as much later on when they're not as healthy and less active. One of my favorite things to show my retired clients is how their plan would have fared during some of the worst times to retire historically, such as right before the '08 financial crisis, using their exact investment allocation, planned withdrawals, etc. So if David and Brad had retired just before the '08 financial crisis, of course, even a well-diversified portfolio of stocks and bonds would have declined in value quite a bit. And they would have hit a lower guardrail here, which only would have meant a cut in spending of about $216 per month. And then years later, as their portfolios recovered, they would have hit several upper guardrails, allowing them to increase their spending even beyond what they started with to get the most out of that retirement nest egg that they worked so hard for. So the bottom line here is that you don't need to put your life savings into restrictive or complex investment and insurance products to have peace of mind in retirement. You just need a better retirement plan. If you're still working, you may not need as much as you think to retire comfortably, since traditional rules of thumb can be overly conservative. And if you're already retired or about to, you can probably withdraw more than you might think from your portfolio. Think about how many more experiences you could have with $10,000 to $20,000 of extra retirement income per year. And if you made it this far, I want to thank you for allowing me to show you this today, and I hope you learned something. If you're wondering what your own retirement income guardrails would look like, I do offer a free assessment for anybody that's considering working with us here at Spark Wealth Advisors. We're an independent firm, meaning we're not beholden to any one company's investment strategies like you might expect at Fidelity, Schwab, or Edward Jones. We're fee only, meaning we don't accept any commissions for the sale of any investment or insurance products like annuities or life insurance. And of course, we are a fiduciary, which means we're legally and ethically required to act in your best interest above our own. Your free assessment would include your personal income guardrails, which would include your investment account withdrawals, as well as any other fixed income sources like pensions or Social Security. It'll include a tailored investment strategy unique to your goals, as well as a tax planning strategy to mitigate taxes throughout your retirement. Check out the form below, answer a few questions for me to see if you qualify. We only do about 3 of these every month to ensure white glove service to our current clients. So see if there's any slots on my calendar below, and I can't wait to meet you. Thanks for joining, and I hope to talk to you soon.